Okay, well, let's get in. William Lee, Chief Economist and Executive Director at the Milken Institute. He's with us now. Lee, good morning. Great to have you with us here. Appreciate it. Good morning, Prashant here. So there are the two big blocks. Talks are continuing, trade negotiations, etc. But the two big blocks which matter for global markets is China and EU. With EU, the big headline overnight was, and I'm quoting this, EU says, expect US tariff talks to make little progress. And of course, with China, apparently both leaders are waiting for the other person to call. So how is this? Is this going to be, in your opinion, how is this going to proceed? Is it going to be protracted? What's your sense?
I would have been stunned if anybody expected that offer of, zero tariffs for zero tariffs to be treated seriously. Ever since the I think WTO has focused in on tariffs and tried to eliminate those tariffs as trade restrictions, the way that most countries have been trying to protect their domestic sectors has been through non-tariff barriers, whether it's explicit quotas or incredible regulatory restrictions and high standards, whether it's health or safety or some other such thing, legal hurdles that American companies are asked to go through. And the Europeans are masters at doing those sorts of non-tariff barriers. And so that really is the heart of the discussion that has to start. So I think President Trump regarded that zero tariff for zero tariff offer as not even an opening salvo. It was a joke. So I don't think that was to be taken seriously. And I think once the Europeans get serious about wanting to open up their markets for U.S. products, then the serious discussions will continue. As you say, the big elephant in the room is China. China has been the focal point of President Trump ever since his first administration. And China is really in a situation where it recognizes that U.S. and China, the two largest economies in the world, the global trade system, as WTO is today, was formed after World War II, set up by the United States to try to help the development and recovery of economies around the world. The U.S. was the only healthy economy at the time. Now we have incredibly strong and powerful emerging countries, India, Brazil, a lot of countries coming out of not just developing stages, but into the middle class. And these middle class emerging countries require things that WTO is not able to do. So I think the key for China and the U.S. is to set a pattern, to really take apart the WTO system as it exists today, arrive at a mutually beneficial trading system for the 21st century, the needs of the 21st century, where you have huge blocks of European, Asian, Middle Eastern and Latin American countries that really have very different needs. Probably will have more bilateral agreements, much more in the way of regional agreements. And that's, I think, going to be the trend going forward. But China has to move with the U.S. Right now, we have a big face-off. There's just no way that President Xi is going to look to anyone like he's being pushed around by an American president. His domestic audience will not allow that. So I think we're going to have quite a bit of, face-saving, belligerence and a lot of tough talk until we start to see movement. And that may take a while.
Yeah, okay. So it will take a while. William, hi, morning. Great to have you on the show today. So the thing is that usually markets ignore a lot of, real economy talk, trade talk and tariff talk until it starts getting real in terms of corporate profits, corporate expansion plans. And look at the example today. NVIDIA's, stock is sliding lower. It's taken, U.S. futures down with it. Generally, there's a risk-off sense in the market again because it's getting real. When you have to spend $5.5 billion in a charge because you can't export a certain number of chips to China or to other countries, it's a straight business hit. From a market perspective, should we believe that the worst of the market volatility, this 7-8% swings in a day, is that over? Can we hope for some calm, or would that be, a little maybe foolish?
That's a brilliant question, because that really is the point of this show, isn't it? Your audience doesn't care about what people like me have to say. They really care about what it is that you were just talking about earlier. Where can you make short-term trades and medium-term trades in order to benefit from the economic environment? And as you say, the volatility has been incredibly high, I think, because the discussion has been misplaced. Everyone is focused on the uncertainty due to tariffs. Oh my God, what are tariffs going to be doing? For me, it's really the the big uncertainty is whether or not President Trump is going to be able to achieve the kind of economic restructuring for the United States and, as I just mentioned, for the global trading system. The Make America Great agenda involves quite a bit of restructuring. And the key policies that will be put in place would be smaller government to release resources for the private sector, lower taxes, fewer regulations, and a tariff barrier, a protective barrier for investors who come into the United States and set up shop. They'll be protected from unfair competition from abroad. Those are the key elements, and the tariffs are but a minor player in those elements. And President Trump is right now dissipating so much political capital. I think the big worry and the source of this volatility are nagging sense of he may not get this agenda through before the midterm elections. And if he doesn't, then game over. So I think that is where the real worry should be, and that has not been talked about enough.
All right, William, good to hear your thoughts as always. This is Nigel on this side. Before we wind down this conversation, I recall a couple of months back when we had a chat, US was the only game in town and the dollar index was getting stronger as well. Things have changed since then. The hope is that there'll be some outflows from the US equities and it could find its way into emerging markets like India. Do you agree?
I think one of the things that would feed that would be diversification. But right now, everyone's afraid about to diversify because the standard tricks for diversification, go to fixed income assets, go to treasuries, safe havens, those don't work anymore. But as I think to follow up what I just said earlier, I think your audience would be interested to know that the dollar weakness and the kerfuffle in the treasury market is not so much due to the loss of the status of the US dollar and lack of confidence in the US exceptionalism, but rather something simple. A lot of leveraged traders out there bought a lot of equities on margin, and now with the crash of stock prices, there are huge margin calls. So what do you do when you have a margin call? You sell the most liquid assets you have on hand, namely U.S. Treasuries and dollar-denominated assets and dollars themselves. So I think that really has been the source of this huge amount of volatility in the bond market, dollar market, which has frozen up any movement anybody has to diversify their portfolios to international equities. So right now, the proof of the pudding of what I just said is that you see that the U.S. Treasury market has come back to more normal status. The dollar, is moving around a bit, but it's still higher than it's been in the last 4 years. So I think one of the things that you should continue to look for would be more signs of deleveraging and more signs of imbalances within institutional portfolios and a lot of the hedge funds out there.
All right. By the way, there's a great background, Lee, behind you. I mean, is that a map or is that there's a painting?
That's a painting.
It's a painting.
That's a painting. It's something my uncle. Those are peach blossoms.
Oh, lovely, lovely. Great background and good to sort of, see this in the morning. Thanks very much, William, and we'll speak again soon.
Thank you so much for having me.
Appreciate your time here. Thank you. Well, I think